Somewhere around age 60, the rules of your financial life quietly rewrite themselves. Nobody sends you a letter. Nobody sits you down and explains it. But 5 separate mechanisms start working against the very money you spent decades building, and most retirees don't notice until the damage is already done. Here's what makes this so infuriating. You didn't do anything wrong to trigger these. You worked. You saved. You followed every rule you were given. And that's exactly the problem. Because you followed the rules, you walked straight into a system built to quietly claim a piece of what you built. Let me clear up a myth right away, because it's the one that costs regular people the most money. A lot of folks assume this stuff only matters if you're wealthy. If you're not rich, why would the IRS bother with you? That assumption is exactly backwards, and it's the belief that does the most damage. Every one of these 5 mechanisms was written decades ago with wealthy retirees in mind. But because the thresholds were frozen in place while everything else in the economy kept moving, they now catch teachers, nurses, factory workers, anyone with a modest pension and a lifetime of savings. If you have any retirement account at all, any Social Security coming your way, this is already relevant to you. Quick disclosure before we go further. I'm not a CPA, not a lawyer, not a financial advisor. Everything in this video is educational, based on current 2026 rules, and your personal numbers matter more than any general explanation. Talk to a qualified professional before making moves based on any of this. Now let's get into it, starting with the one that feels the most like a broken promise. The first mechanism targets your Social Security directly. Up to 85% of the benefit you spent your whole career funding can end up back in your taxable income. Sit with that for a second, because it doesn't feel like it should be legal. You paid into Social Security with after-tax dollars for 30, 40, sometimes 50 years. The natural assumption is that the money comes back to you clean. Instead, depending on your income, most of it can be taxed a second time. The way this gets calculated is through something called provisional income, basically half your Social Security benefit added to your other income sources. Cross a certain line as a single filer, and half your benefit becomes taxable. Cross a higher line, and it jumps to 85%. For singles, those lines sit at $25,000 and $34,000. For couples, $32,000 and $44,000. Here's the part that should actually make you angry. Those numbers were set in the early 1980s, with a second tier added in the early 90s, and they have never once been adjusted for inflation. Not once, in over 40 years. Back then, a retiree earning $25,000 a year was considered comfortable. This tax was marketed as something that would only touch the wealthiest 1 in 10 retirees. Today, because the threshold never moved while the cost of everything else did, it reaches more than half of everyone collecting Social Security. A tax designed for the top of the pyramid now lands on the middle of it, purely because Congress left the line frozen and let inflation walk everyone across it. Picture a single retiree pulling in $24,000 a year from Social Security, plus another $18,000 from a retirement account to cover living expenses. Add half the Social Security benefit, $12,000, to that $18,000, and you're already at $30,000 of provisional income. That's already past the first threshold. Add a small pension or a bit of interest income, and you sail past the second one too. Now up to 85% of that person's Social Security is taxable, someone living on around $42,000 a year total, not exactly wealthy by any definition. And it gets worse with time, because Social Security gets a cost of living adjustment most years. That raise is meant to help you keep pace with inflation, but a bigger benefit means more provisional income, which can push you across a threshold you hadn't crossed before. The very raise meant to protect you can be the thing that pulls more of your own benefit into the tax net. The second mechanism doesn't just tax your money, it takes away your say in when that money gets touched at all. For your entire working life, traditional retirement accounts were sold to you with a simple pitch: contribute before tax, let it grow untaxed, and pay the tax later, presumably when your income is lower. What doesn't get emphasized is that later isn't up to you. Once you hit a certain age, currently 73 for most people retiring now, the government requires you to withdraw a minimum amount every single year, whether you need the money or not. These are called required minimum distributions, and required isn't a polite suggestion. A retiree sitting on $800,000 in a traditional account could be forced to pull out around $30,000 in year 1 alone, every dollar of it taxable as ordinary income. And if you don't take it, the penalty is a steep excise tax on whatever you should have withdrawn. There's no quiet way around this one. The system pulls the money out, taxes it, and fines you if you resist. The real lesson here is that your traditional retirement account was never fully yours in the way it felt. A portion of it was always the IRS's, deferred but never forgiven. The required withdrawal is simply the moment the government collects on its own schedule instead of yours. The third mechanism is where things really start to compound, because it turns your forced withdrawals into a second, hidden bill, this time disguised as a Medicare premium increase. Medicare premiums for the parts covering doctors and prescriptions aren't flat for everyone. Cross certain income thresholds, and you're charged a surcharge on top of the standard rate, sometimes running hundreds of extra dollars a month. This surcharge has an official name, the Income-Related Monthly Adjustment Amount, but what matters is what triggers it: income, specifically the income created by those forced withdrawals and the newly taxable Social Security we just covered. Watch the sequence. The IRS forces a withdrawal. That withdrawal raises your income. That higher income crosses a Medicare threshold. Suddenly your premium jumps. In 2026, those thresholds start around $109,000 for a single filer and roughly $218,000 for a couple. At the top tiers, a single retiree can pay upward of $600 a month for the exact coverage a neighbor gets for under $200. That's a gap of over $400 a month, purely because income crossed a line. Income that, again, may have been forced on you in the first place. Here's the cruelest detail. This surcharge is based on your income from 2 years earlier. So this year's Medicare bill reflects what your finances looked like 2 years ago. A single large withdrawal today can quietly spike your healthcare costs years down the road, long after you've forgotten what caused it. The fourth mechanism is subtle enough that even some tax preparers miss it entirely, and it's the reason your real tax rate can be far higher than the bracket you think you're in. Most people assume their bracket tells the whole story. 12% bracket, 12 cents on every extra dollar. For a retiree collecting Social Security, that assumption can be badly wrong, because every extra dollar you withdraw doesn't just get taxed on its own. It can simultaneously pull more of your Social Security into the taxable zone. $1 of new income can create well over $1 of new taxable income. Say you withdraw an extra $1,000 expecting a 12% hit, about $120 in tax. But that $1,000 also raises your provisional income enough to make another $850 of your Social Security newly taxable. Now you're not paying tax on $1,000, you're paying tax on $1,850. At the same 12% rate, your real tax on that single withdrawal is more than double what you expected. Financial planners call this the tax torpedo, and in certain income ranges, your effective rate on an extra dollar can hit 22, 30, even 40%, while your tax software quietly shows you a bracket that has nothing to do with your actual cost. The fifth mechanism isn't really a tax at all. It's an opportunity the IRS lets you lose simply by staying silent while the clock runs out. Between the day you retire and the day forced withdrawals begin at 73, there's a window, often the lowest income years of your entire retirement. During that stretch, you're not yet forced to withdraw anything, and you may not be drawing full Social Security yet either. That window is arguably the single best tax planning opportunity most retirees will ever have, because it's the moment you can move money at low, controlled tax rates instead of waiting for the system to force it out later at a much higher effective cost. The tragedy is that most people don't know the window exists, so they simply let it pass. They enjoy a few comfortable low-tax years, leave their accounts untouched, and assume that's the responsible choice. Then 73 arrives, the forced withdrawals begin, the Social Security tax kicks in, the Medicare surcharges follow 2 years later, and every mechanism lands at once, because the one window that could have softened all of them was never used. Now here's the part that actually matters, because every single one of these 5 things can be reduced, and some avoided almost entirely, if you act inside that window. The most powerful tool is a Roth conversion done during your low-income years. You deliberately move money from your traditional account into a Roth, paying tax now while your rate is low, instead of later when forced withdrawals would tax it at a much higher effective rate. Once that money sits in a Roth, it grows tax-free, comes out tax-free, and, critically, doesn't count toward provisional income, meaning it doesn't drag your Social Security into the taxable zone or push you across Medicare thresholds. Spread across several years in careful amounts, this single strategy can save a retiree tens of thousands of dollars over a lifetime. The second tool is the qualified charitable distribution. Once you reach the eligible age, you can send money directly from your retirement account to a charity. That gift satisfies your required withdrawal for the year, but because it never lands in your bank account, it never counts as taxable income. Same gift, same requirement met, but none of the downstream cascade, no Social Security tax trigger, no Medicare bump. The third tool is simply being deliberate about which account you pull from and when. Roth withdrawals don't count toward provisional income. Traditional withdrawals do. A retiree who blends withdrawals thoughtfully, some from traditional, some from Roth or savings, can stay just under the thresholds that would otherwise tax their Social Security or spike their Medicare premium. Same money in your pocket, very different tax outcome. And right now there's a temporary bonus worth knowing about. An additional deduction for seniors on top of the standard deduction, worth several $1,000s per person, created specifically to offset some of this burden. It's new enough that some tax software and preparers haven't fully caught up to it, so it's worth asking directly whether it's been applied to your return. Picture a couple in their late 60s who did everything right, diligent savers, over $1 million combined in their accounts, a pension, Social Security, everything looking secure. For years, their income stayed modest, their taxes stayed low, and doing nothing felt like the responsible choice. Nobody told them those quiet years were actually the best opportunity of their financial lives. Then 73 arrived. Because their accounts had grown so large, their forced withdrawal was enormous, far more than they needed to live on. That income pushed the majority of their Social Security into taxable territory, shoved them into a higher bracket than they'd ever seen while working, and 2 years later triggered a Medicare surcharge that added thousands to their healthcare costs. Every mechanism hit at once, all traced back to one quiet decision: doing nothing during the window because nobody told them the window existed. It was completely legal, and it was completely avoidable. That's the real lesson here. This system isn't designed to punish carelessness. It's designed to quietly collect from people who did everything right and simply weren't told what was coming. So here's what to actually do with this. If you're in your 60s and not yet forced to withdraw, recognize that you are standing inside the single most valuable tax window of your retirement, and it closes a little more every year. Look seriously at Roth conversions while your income is low. If you're charitably inclined, use qualified charitable distributions to satisfy required withdrawals without the tax hit. Be deliberate about which accounts you draw from. Make sure the new senior deduction is actually being applied to your return. And above all, don't mistake inaction for safety. Letting the window close without using it is, by far, the most expensive decision on this entire list. Your exact numbers, your account size, your income, how many years are left in your window, are personal, and they're what actually determines whether a strategy saves you a little or a great deal. A video like this can show you the map, but only you can walk it with your real numbers in hand. If this opened your eyes to something you hadn't considered, that's exactly why this kind of breakdown matters. And if you know someone in their 60s who assumes doing nothing is the safe move, send this their way while their window is still open.